Okay, so you want to own a billboard. Find a piece of land near a busy highway, put up a giant sign, rent the face out to whoever wants to advertise, and collect a check every month without doing much of anything. It sounds almost absurdly passive. You're not making a product. You're not providing a service. You're not even really working. You're just selling the air in front of a road that people were already driving down anyway. Sounds simple. It is not simple. And the story of how billboards actually make money, and how the biggest operator in this business managed to drown itself in billions of dollars of debt while owning assets that print cash, is one of the more instructive stories in American finance. Because a billboard is not what it looks like from the road. From the road, it's a sign. From the inside, it's a permit. It's a land lease. It's a regulatory battle that can last longer than the mortgage on a house. And it's a business where the difference between a great location and a merely decent one isn't a few $1,000s a year. It's a completely different financial life. By the end of this, you'll understand exactly why 3 companies control the majority of the billboard market in the United States, why it is genuinely difficult for new operators to break in, and why the fundamental economics of outdoor advertising reward the patient and punish the overextended in ways that are not obvious until you're already in the middle of it. Let's start with what you're actually buying, because most people get this wrong from the beginning. A billboard is not a sign. Signs communicate information. A billboard sells attention. Specifically, it sells a slice of the attention of every driver who passes a fixed point on a road, measured in units of 1,000, what the industry calls a CPM, or cost per 1,000 impressions. You are not selling advertising space. You are selling a moment of guaranteed human attention at a specific GPS coordinate. And the value of that moment is determined almost entirely by one thing that has nothing to do with the sign itself: how many cars drive past it per day. This distinction matters because it means the sign is almost irrelevant. 2 identical steel structures, one on a state road carrying 8,000 vehicles per day and one on an interstate carrying 80,000 vehicles per day, are not the same business. They are not even in the same industry. The traffic is the asset. The sign is just the container you put around it. And that traffic, measured by what the industry calls average daily traffic counts, published by state departments of transportation, is what determines everything. What you can charge advertisers, what the land underneath you is worth, and what any rational buyer would pay to acquire your structure. According to the Out-of-Home Advertising Association of America, the U.S. billboard industry generated approximately $9.1 billion in total revenue in 2024, up about 4.5% from the year before. The vast majority of that revenue flows from a relatively small number of high-traffic locations that were locked up decades ago by operators with the foresight to get there first. So what does it cost to become one of those operators? The answer depends almost entirely on whether you're building from scratch or buying an existing structure, and both paths have costs that are not visible from the road. Building a new static billboard, the traditional kind with a printed vinyl face, requires first erecting a steel structure. A single-face static bulletin, the standard 14 by 48-foot billboard you see along most highways, costs roughly $15,000 to $40,000 for the steel pole and structure alone. Add the face, the lighting equipment, and the installation labor, and a modest static structure on flat land with easy access runs somewhere between $25,000 and $60,000 to put in the ground. That sounds manageable. A digital billboard, the LED screen version that cycles through multiple advertisers every 8 to 10 seconds, is a different calculation entirely. Building a new digital billboard in the United States in 2025 costs between $150,000 and $500,000, depending on the screen size, pixel resolution, and the complexity of the engineering required. Premium highway units with dual faces and tighter pixel pitch can exceed $750,000 once installation is factored in. The screen alone on a mid-grade digital unit runs between $100,000 and $250,000. Then the structure beneath it. Then the electrical supply, because a digital billboard draws significant power continuously and needs a dedicated meter. Then the data connection, because modern digital billboards are remotely managed and need reliable connectivity to receive and display ads. Buying an existing structure rather than building one typically costs more upfront, but saves you the construction risk. Established billboard locations trade on income multiples. Industry brokers typically value stabilized billboard ground leases at somewhere between 6 and 10 times annual ground rent, and individual billboard structures at between 8 and 15 times their annual net operating income. A billboard generating $36,000 per year in net income after land lease and basic costs might trade for $288,000 to $540,000. A high-performing digital unit in a metro area generating $120,000 in net annual income could command $1.2 million or more. OUTFRONT Media, one of the 3 dominant players in this industry, acquired approximately 950 billboard displays in Portland, Oregon and Clark County, Washington in 2022 for $185 million, roughly $195,000 per display on average, and that was for an existing, operating portfolio with contracts already in place. But here's the cost nobody factors into their initial calculation, and it's the one that has stopped more aspiring billboard operators than any other single factor. Before you build anything, before you spend $1 on steel, you need a permit. And in the billboard business, getting a permit is not a formality. For many locations, it is the entire game. The Highway Beautification Act of 1965, signed by President Lyndon Johnson largely at the insistence of First Lady Lady Bird Johnson, established federal controls on outdoor advertising along interstate highways and other federally aided roads. The act restricts billboards to commercial and industrial zones, sets limits on size and spacing, and requires states to maintain what it calls effective control of outdoor advertising, or risk losing 10% of their federal highway funds. States then layered their own regulations on top of the federal framework. Cities layered their own rules on top of the states. The result is a regulatory patchwork where the rules genuinely vary not just state by state, but municipality by municipality. In some jurisdictions, new billboard permits are effectively impossible to obtain. Several major cities have had outright moratoriums on new billboard construction for years. In California, many localities require environmental reviews and traffic impact studies before a permit is even considered. Permit applications in competitive markets can take 12 to 18 months to process and can still be denied. The permitting process in western Pennsylvania typically takes 60 to 120 days under reasonable circumstances, according to outdoor advertising specialists in that region, and involves local zoning approval, building permits, and state highway department clearances, all running simultaneously. Permit costs alone, including application fees, engineering reviews, and any required public hearings, can add several thousand to tens of thousands of dollars to a project before a single piece of steel goes into the ground. There is also the land lease. Billboard operators almost never own the land under their structures. They lease it. A standard billboard ground lease runs anywhere from $1,200 to $15,000 or more per year, depending on location, with most suburban highway locations somewhere between $3,000 annually. Digital locations in high-traffic metro areas can command significantly more. That lease payment starts the moment the structure goes up, regardless of whether any advertiser has signed on yet. Insurance on the structure adds another $500 to $3,000 per year, and in most states, the billboard structure itself is subject to property tax assessment, which can add several hundred to a few $1,000s annually to the fixed cost load. Add it together: land lease, permit fees, insurance, property tax, structure maintenance, and electrical costs for a digital unit, and a small operator's fixed cost base before selling a single advertisement can run $10,000 to $25,000 per year for a static billboard, and $30,000 to $70,000 or more for a digital one. Now let's talk about where the money comes in, because the revenue mechanics of a billboard are layered in ways that most people looking from the outside never see. The simplest layer is what the industry calls a showing, or a posting, one advertiser renting the entire face of a static billboard for a 4-week period. National average pricing for a 4-week static bulletin in a mid-size American market runs roughly $1,500 to $5,000, according to data from the outdoor advertising platform AdQuick. In major metros, that same period on a premium highway unit runs $8,000 to $25,000. On the Sunset Strip in Los Angeles, rates can reach $35,000 to $100,000 per 4-week cycle. The face isn't just paper, it's a vinyl or mesh print, and the cost of printing and installing a new face typically runs $500 to $1,200 each time a new advertiser goes up, a cost that is either absorbed by the operator or passed through to the advertiser depending on the contract. A digital billboard changes this calculation fundamentally. Instead of one advertiser occupying one face for 4 weeks, a digital screen typically cycles through 6 to 10 different advertisers every 8 to 10 seconds across a 24-hour day. Each advertiser buys time on the rotation rather than exclusive possession of the face. According to industry pricing data, digital billboard advertising costs between $1,200 and $15,000 per month per advertiser slot, depending on traffic volume and market. If a digital billboard in a suburban market prices each of its 8 rotation slots at $2,500 per month, that single screen generates $20,000 per month in gross revenue, roughly $240,000 per year, from one piece of steel. A static billboard in the same location charging $3,000 per 4-week posting generates about $39,000 per year. The digital premium is real, and it is the reason every major operator in this industry has been converting static inventory to digital as fast as permit approvals allow. A third revenue layer that most individual operators underutilize is programmatic advertising, the same technology that powers digital ad buying on websites. Programmatic platforms allow advertisers to buy specific time slots on digital billboards in real time, targeting by hour of day, day of week, weather conditions, or audience demographics derived from mobile device data. Lamar Advertising, the largest billboard company in North America with over 360,000 displays and approximately $2.21 billion in annual revenue as of 2024, reported that programmatic revenue grew by 70% in the third quarter of 2024 alone. The CPMs on programmatic buys typically run higher than direct sales. Buyers pay a premium for the data and flexibility, but the transaction costs also run roughly 10% of the sale, compared to about 6% for direct sales through traditional account executives. A fourth layer exists for operators large enough to attract national brands, what the industry calls sponsorships, or long-term contracts, where a single advertiser commits to a specific location for 6 months, 12 months, or longer at a negotiated rate, providing revenue certainty in exchange for a slight discount from spot pricing. For a small operator with 1 or 2 billboards, landing even one local business on a 12-month contract at $2,000 per month is the difference between a business that feels stable and one that's constantly chasing the next posting. Here's where the fixed cost trap announces itself, because this is the part of the billboard business that new operators consistently underestimate. The costs of running a billboard do not go away when the face is empty. The land lease is due every month whether or not anyone is advertising. The insurance premium is annual and non-negotiable. The property tax bill arrives whether the structure is generating revenue or sitting dark. For a digital billboard, the electricity draws continuously. Screens don't go to sleep when there's no paying advertiser running. A mid-size LED screen consumes between $300 and $800 per month in electricity costs just to stay lit. Routine structural maintenance, inspections, repainting steel, replacing lighting components, servicing the electrical system adds another $1,000 to $3,000 per year for a static unit and significantly more for a digital one whose LED panels and control systems require ongoing technical upkeep. What this means in practice is that a billboard has a minimum occupancy threshold below which it cannot operate profitably, and that threshold is not zero. An operator who fills a digital billboard to 60% of its available inventory is not earning 60% of full revenue while running 60% of full costs. The costs are essentially flat. The revenue is proportional. Vacancy is pure loss, compounded. The industry calls this concept occupancy rate, and according to industry analysts who track the major public companies, the 3 dominant players, Lamar, OUTFRONT, and Clear Channel Outdoor, typically operate their national portfolios at occupancy rates in the range of 70 to 85%. The gap between those two numbers, 70 and 85, represents enormous swings in profitability on a fixed cost base. For a small independent operator with a handful of billboards and no sales team beyond the owner, achieving and maintaining high occupancy is not guaranteed. It is the central challenge of the entire business. The hidden mechanism underneath all of this, the structural vulnerability that separates the billboard business from almost every other small business model in America, is the permit. Not the permit to run ads, the permit to have the sign exist at all. In most jurisdictions, billboard permits are not freely transferable and do not automatically renew. They are issued to a specific operator for a specific structure at a specific location, and they are governed by whatever zoning rules existed at the time of issuance. This creates a dynamic that is deeply counterintuitive. A billboard permit, once obtained in a desirable location, is often worth more than the physical structure beneath it. The steel can be replaced. The permit cannot always be replaced. When a city changes its zoning ordinance, or when a new highway project requires the removal of an existing billboard, the dynamics become severe. The Highway Beautification Act does require compensation when billboards are removed for highway projects, but the compensation is often bitterly disputed, and removal for any other reason, a change in local zoning, a property sale, a permit that lapses through non-compliance, carries no such protection. Worse, because so many jurisdictions have moratoriums on new billboard construction, losing an existing permitted location does not simply mean finding a new one. It may mean losing the location permanently, because no new permit will be issued to replace it. This permit dependency explains why the three largest billboard companies have spent decades and hundreds of millions of dollars acquiring existing operators rather than building from scratch. When OUTFRONT Media acquired 950 billboard displays in Portland and Clark County for $185 million in 2022, they were not really buying steel. They were buying 950 sets of regulatory approvals that would be nearly impossible to replicate through the permit process. Lamar Advertising, according to its own 2024 annual report, operates over 360,000 displays across the United States and Canada. That number represents not just inventory but a vast portfolio of regulatory positions that accumulated over more than a century. Lamar was founded in 1902, and that a new competitor could not replicate in a reasonable time frame regardless of capital. Now let's look at what happens when that structural advantage gets buried under debt. Because the most instructive case study in the billboard industry is not a small operator who ran out of money. It's one of the biggest companies in the space, and the story of how it got there begins with a radio company. Clear Channel Communications, based in San Antonio, Texas, grew through the 1990s and 2000s into one of the largest media conglomerates in the United States, owning hundreds of radio stations and a large outdoor advertising division. In 2008, the private equity firms Bain Capital and Thomas H. Lee Partners took Clear Channel private in a leveraged buyout valued at approximately $19 at the time, one of the largest leveraged buyouts in American history. The deal was completed just as the 2008 financial crisis was beginning. The outdoor advertising division, Clear Channel Outdoor, was spun off as a separate public company but remained majority-owned by the parent. The problem was the debt. The parent company, eventually renamed iHeartMedia, carried approximately $16 billion in long-term obligations from the buyout. When iHeartMedia filed for Chapter 11 bankruptcy protection in March 2018, Clear Channel Outdoor was technically insulated as a separate entity. It had not filed for bankruptcy and was not a debtor in the iHeart cases. But the years of operating inside a debt-burdened parent had consequences. Clear Channel Outdoor itself was carrying over $5 billion in debt as of early 2025, according to SEC filings. Annual interest payments on that debt ran above $400 million per year, consuming a significant portion of the company's operating income. To understand what $400 million per year in interest looks like against the billboard business, consider the scale. Clear Channel Outdoor generated approximately $2.3 billion in total revenue in 2024, according to its annual report. After paying operating costs, land leases, personnel, maintenance, utilities across its entire network, and then interest, the company's net profit position was deeply constrained. The business itself was generating cash. The debt service was consuming much of it. The company spent years selling international divisions and restructuring its balance sheet. Not because the billboard operations were failing, but because the capital structure around those operations was unsustainable. As of late 2025, Clear Channel was working through a take-private transaction, partly aimed at resolving the ongoing pressure from its debt load. The lesson here is not that billboards are a bad business. The lesson is that the billboard business is a fixed asset business with relatively thin operating flexibility. The structures are expensive to build, the permits are difficult to obtain, and the revenue is tied to advertising cycles that can soften quickly in a recession. Layering enormous debt service on top of those characteristics creates a situation where even years of solid operating performance cannot outrun the interest clock. Let's put two concrete scenarios side by side so the economics become tangible. In the good year, you own a single digital billboard on a suburban interstate corridor carrying 45,000 vehicles per day. The structure cost you $350,000 to build 3 years ago, which you financed at $24,000 per year in debt service. Your land lease runs $6,000 per year. Electricity, maintenance, insurance, and property tax together run another $18,000 per year. Your total fixed costs are $48,000 annually. You have 6 advertiser slots on an 8-second rotation. In a strong local advertising market, you fill 5 of the 6 slots at an average of $2,800 per month each. Annual gross revenue, $168,000. After direct sales commissions of about 15%, net revenue is approximately $143,000. Subtract fixed costs of $48,000. Net operating income, $95,000. A margin of roughly 56% on net revenue. At that rate, you pay back the original $350,000 investment in approximately 3.7 years. Not a bad business. In the bad year, a regional recession hits. 2 of your 5 advertisers, a car dealership and a home improvement retailer, cut their outdoor advertising budgets in the first quarter. You spend 3 months with only 3 slots filled before landing 2 replacements at lower rates, averaging $1,900 per month. Annual gross revenue drops to $114,000. After commissions, net revenue is $97,000. Fixed costs remain at $48,000 because the land lease, debt service, and electricity do not respond to the advertising market. Net operating income, $49,000. The difference between the good year and the bad year, for the exact same piece of steel at the exact same location, is $46,000. Nearly half your income gone. Not because anything about the business changed, but because 2 advertisers made different budget decisions. Now multiply that across a portfolio of 50 billboards, or 500. The fixed cost structure does not compress, the revenue does. This is why, despite the math being genuinely attractive in good conditions, the large institutional players have maintained such a dominant grip on this market. Lamar Advertising posted $2.21 billion in net revenue in 2024 with an adjusted EBITDA of $1.03 billion, an EBITDA margin of approximately 47%. That kind of margin is exceptional for an infrastructure business. It exists because at Lamar's scale, 360,000 displays, a national sales force, national contracts with brands like McDonald's, Apple, Coca-Cola, and Verizon, that the Out-of-Home Advertising Association of America identifies as top billboard spenders. The fixed costs per display are spread thin and the occupancy rates stay high even when individual markets soften. A small operator with 10 displays in one metro area has no such cushion. When the local market softens, all 10 signs are exposed simultaneously. Sophisticated individual investors who do buy into the billboard space tend to approach it less like buying a business and more like buying a very specific kind of real estate. A stabilized billboard ground lease paying $12,000 per year, evaluated at a 10 times revenue multiple, might sell for $120,000. At that price, the yield to the buyer is 10% annually, with 0 operating responsibility. The billboard operator handles everything. The ground lease investor simply collects rent. This is similar in structure to net lease commercial real estate, and it attracts many of the same investors. Those who want predictable, low management income, tied to a physical asset that cannot simply disappear. What makes billboard ground leases particularly attractive as a passive investment is the escalation clause. Most long-term billboard leases include annual rent increases of 2 to 3%, or a consumer price index adjustment, providing a modest but reliable inflation hedge over the life of the lease. And because the supply of high-traffic locations is genuinely constrained, you cannot add more cars to an interstate, and you cannot manufacture new permitted billboard locations in jurisdictions with moratoriums. The underlying income stream tends to be durable in a way that retail or office leases are not. So what is a billboard? From the road, it's a sign. That's not wrong, but it's the least important thing about it. What a billboard actually is, stripped down to its economic core, is a permitted position in the field of view of a moving audience. The audience didn't choose to be there. They're just driving, and every 8 seconds, or every 4 weeks, or every 12 months, someone pays you for the chance to interrupt that drive with a message. The sign is just the hardware. The permit is the franchise. The traffic is the inventory. And the business, the real business, is the gap between what the advertiser pays for that interruption and what it costs you to hold the position in the first place. When that gap is wide and the position is secure, a billboard is as close to a permanent income stream as a physical asset can produce. When the gap narrows, when advertisers pull back, when a city changes its zoning, when interest rates rise and the debt service on a portfolio of structures becomes the dominant financial fact of the enterprise, you discover that what looked like a passive asset was actually a leveraged position in the attention economy, fully exposed to the cycles of the businesses advertising around it. The structure doesn't move, but the economics underneath it absolutely do.